Welcome to The Explainer. Companies have to tell us about their financial health, but what about their financial future? Today, we're going to decode the very specific language they use to talk about things that might or might not happen down the road. So here's what we've got lined up. We'll kick things off with a big problem. How do you account for an unknown future? Then we'll look at both sides of that coin, the potential good stuff and the potential bad stuff. After that, we'll draw a really clear line between some tricky terms that sound similar but mean very different things. And finally, we'll tie it all together and talk about why this is so important for you. All right, let's just dive right in with a perfect example that gets to the heart of this whole thing. Imagine a company gets slapped with a massive lawsuit. It happens all the time, right? But the outcome is totally up in the air. How in the world do you put that on a balance sheet? Answering this is really the key to the whole puzzle. Okay, let's start with the fun side of things, the optimistic view, the potential windfall. What happens when a company might actually gain something from an uncertain event? So the official term for this is a contingent asset, and it's exactly what it sounds like, a possible asset. It's not guaranteed. Think about a company that's suing someone else. They might win a huge settlement, or they might get nothing. That's a contingent asset. So let's break that down. First, something has already happened in the past, but the money, the actual benefit, hinges on some future event that the company can't just snap its fingers and make happen, like, a judge's ruling. And here's the rule, the core idea behind how accountants handle this. It all comes down to a principle called prudence. Basically, accountants are a cautious bunch. They absolutely do not want to record income that might just be a mirage. So what's the bottom line here? It's simple. Companies do not put these potential wins on their main financial statements. It would be totally misleading. It's the ultimate accounting version of don't count your chickens before they hatch. Now let's flip the coin over. What happens when a company might have to pay up? What if they lose? This is the potential obligation. Okay, this one's a little trickier. A contingent liability can actually be one of two things. It's either a possible future debt that hangs on some uncertain event, or it's a debt that kind of exists right now, but it's just too uncertain to officially put on the books yet. Here's a perfect example of that first type. A past event happened, Mr. X sold a machine, but the obligation to actually pay for that injury, well, that's not a sure thing yet. It's only a possible obligation. And here's the other flavor. In this case, there's an obligation right now because of the fire, but, and this is the key, it's not considered probable that they'll have to pay, or maybe they just can't nail down a reliable dollar amount. So for now, it stays off the main balance sheet. So if these things aren't on the balance sheet, where are they? Well, companies have to talk about them. They disclose them in the footnotes of their financial reports. And trust me, those footnotes are where the really interesting stories are often buried. All right, this is where it all comes together. We have to draw a clear line between what's certain and what's just possible. To do that, we need to introduce one more really important term, a provision, so we can see how companies decide what makes the final cut. Yeah, it can get confusing, right? They all sound kind of similar. Let's use an analogy to make this super clear. Just think of it like a financial weather forecast. A liability is a sure thing. It's a debt you absolutely owe right now. In our weather forecast, the rain is already falling. A contingent liability, though, that's just a chance of rain. Maybe there's a 30% chance. It might happen, it might not. Now let's talk about a provision. This is the step between a mere possibility and a certainty. It's when paying out is probable, not just possible, and you can reasonably estimate how much it's going to cost. In our forecast, this is a 90% chance of rain. You are definitely grabbing an umbrella. The contingency is more like, the forecaster mentioned it might drizzle. Big difference. So you can see accountants follow this simple, logical path. They ask these three questions. If the answer is yes to all three, boom, it's a provision, and it goes on the balance sheet. But if the answer to number 2 or number 3 is no, it stays a contingent liability, hidden away in the notes. This example makes it crystal clear. The company gets a fine. What happens next all comes down to management's judgment. If they look at the situation and think, yep, we're probably going to have to pay this, they create a provision. If they think, it's less likely, they just disclose it as a contingent liability. Okay, so we've waded through the technical stuff, but this isn't just a boring accounting exercise, I promise. Let's talk about why this all really matters to you and how you can learn to read between the lines. Seriously, why should you care? Because this is not just for accountants. Whether you're an investor, an employee, or just trying to understand the world, this stuff gives you a much fuller, more honest picture of a company's real financial health and all the risks lurking under the surface. So here's what I really want you to take away from all this. The big numbers on the balance sheet, they only tell you part of the story. The real drama, the potential plot twists, are hiding in the footnotes. That's where you find the hidden risks. And it all boils down to that one critical difference between probable and possible. One is a storm cloud on the horizon. The other is a storm that's already overhead. And that kind of leaves us with one last thought. The numbers in a report, they tell you what is. But the notes, the contingencies, they tell you the story of what might be. And when you're looking at a company, that's a story you absolutely cannot afford to skip.